Hello and welcome to MF Corner. I'm Sonal Bhutra. With me as always is Vinnii Motiwala. And on the show as always, we'll talk about different aspects of investing in mutual funds, what could possible strategies be. And this time around, it's a lot around people who do not have a fixed paycheck. Let's get started with that, Vinnii.
Absolutely. There are a lot of people who do not have fixed paychecks, who are consultants, freelancers. How should they be investing? What is the strategy or approach they should have while investing in mutual funds? Is it lump sum? Is it SIP? Because you have to save for May days as well. You have to save for bad days as well. So how do you go about that? Now, to talk to us about all of this, understand what one should be doing, we have Kushal Bhagi, who is the owner at PCC Investing, joining us on the show. Kushal, thank you so much for joining us this afternoon. With not having a regular income, what is an investment approach, or what are the top 2-3 investment approaches that one could go if they're looking to invest in mutual funds?
Great. Thanks for having me on the show. And yes, I agree. It's a pretty interesting topic in these times. I think the first thing is that if you have irregular income, you have to stop thinking about monthly SIPs, right? Today, SIP is the buzzword, but if you're not earning every month, then you can't invest every month. So you have to sort of change the game. You have to change the way you think. And you should be thinking about maybe something like goal-based planning, or if that is a little too complicated, especially for investors who are starting off first time or directly, then think about how much you want to invest every year, for example. The idea of thinking this way is that you stop getting into the trap of what happens if I miss my monthly installment, right? So you take that out of the equation altogether. And you're saying that as and when you receive the income, you should deploy that income into your investments. Now, what makes it easy to be able to deploy that income into investments, and this is a pretty important point, is that it really pays to have proper asset allocation and a predefined model portfolio. So for example, if you have a model portfolio of 60% debt, is 60% in equity, 30% in debt, and 10% in gold and silver, then you select your funds in such a way that as soon as you receive these incomes, you are able to deploy it right away. And this takes care of a lot of the decision fatigue. This takes care of a lot of errors, as we'll probably see during the course of our conversation, that could creep into your investing habits. And third, I'd say focus on liquidity first. So if we go to our 60-30-10 example, where 30 is debt, focus on filling the fixed income bucket first. Right? Because, for example, if you need funds, then you're not forced to sell and liquidate your equity at wrong times. You can let that equity compound with time as it goes along. And you want a little psychological buffer, So fill your fixed income needs first, fill your debt part first, and then you can start focusing on growth and chasing returns.
All right, we take that point, Kushal. So you said, of course, it could be very volatile and you have to look at some principles when you are investing without a fixed income every month. But there could be some days when you will have high income, right? In that case, how can one prioritize emergency funds versus long-term investments? How can one plan their investments around those high income months?
See, if I have to be very simple about it, I would say that when you receive irregular income and when the income hits your bank account, there is a natural tendency to be very aggressive with your investments, right? So again, I would say if you go back to the 60-30-10, you fill the 30% bucket first, fill the debt bucket first, and even within debt, you prioritize your emergency fund corpus above everything else. Okay, I think that is the point which everybody should do. And also, if you are looking at prioritizing that 30%, it becomes very important to say, instead of having a 6-month buffer, which most people might do, have a 9 to 12-month buffer. So give yourself a little bit of time, give yourself a little bit of space to be able to keep that buffer for yourself.
Okay, so keep a higher buffer, emergency fund first, pay the debt off. Okay, after all this, now after all this, the 70% which I have, okay, where should I be looking to invest in? Or an investor who has irregular income look to invest in, should it be active mutual funds for maybe potential outperformances, or passive index funds for more of stability? And if they choose each of these options, why also?
So I think if you're investing directly, then you should stick with core passive products as your main portfolio. And the reason is that it's quite simple, right? You have only one product to choose from in a category. If you're large cap, you're going Nifty 50. If you're mid-cap, you might go mid-cap 150, for example. The problem with having active funds is that it can get quite complicated. First of all, the choice is quite wide. You have 30 odd funds to choose from within a category itself. Sometimes to select that fund itself might take you a very long period of time. And then also what happens with active funds is once you do select an active fund, there is a tendency to keep comparing performance, not just against a benchmark, but against other sort of products as well. And therefore, there's a higher chance of saying, my fund is not going to perform, my fund is not performing as well. Can I switch and move to another best performing fund? And we've seen this, right? This keeps happening all the time. And that sort of pollutes the investment process in the whole place. I think if you have an irregular income, it's anyways complicated. So let's keep things as simple as you can. Yes, if you are investing through an intermediary, then you could have a more judicious mix of active and passive. But if you are a direct investor, I would say the core of your portfolio should be in passive funds, and you can have a little bit of active funds, just like I said, to try and get that little bit of kicker in terms of returns.
Okay, so in that case, if somebody, you said SIPs are not always possible, right? A fixed amount every month, because you're not getting fixed amount every month. In that case, how can one go about it? Flexible SIPs, you keep changing it, which I think could be a little more procedural in equity mutual funds, or lump sum investments during high income months. How can one go about it?
So flexible SIPs essentially means that your base level of SIP is set much lower, right? But there's always going to be some manual intervention that comes about it. I think when you're moving from SIP investing to an annual investing or goal-based investing, or when you have irregular income, what you need to understand is that you are moving away from automation, and all of a sudden discipline is the mantra, right? Because every time a income hits your bank account, there is a decision to be made about which funds to invest, where to invest, how much to invest. And it's unlike a normal SIP, right, where you do all the work upfront and everything just gets automated every month. So I'll come back to what I said at the start. It makes sense to have a model portfolio, do your asset allocation. So as soon as you receive your funds, you just invest it in the weightage that you've decided, and that is what works best.
Okay. Kushal, nowadays, we talk about investing in different forms of mutual funds as well. There's so many options, right? Flexi cap is there. There are different types of other hybrid funds, debt or dividend yield mutual funds. How should the allocation be, or how should they go about in terms of a mix for all of this? Or should it be just focused on one of those kinds of funds?
So I think your question is also assuming that you need multiple funds to create multiple buffers, right? So for example, balanced advantage funds or any other package product. A package product is used to be able to help and aid investor behavior, right? Help an investor remain invested through various ups and downs, make the journey a little smoother. I think if you're looking at a resilient portfolio, what you should be looking at is at assets that have less correlation with each other. So for example, in the 60-30-10 example we talked about, your 60% in equity is looking after the growth, your 30% debt is looking after stability, and 10% in gold and silver, if we can still call it a hedge in today's times, you're looking at that. So you've broadly got all the aspects covered, right? So I think instead of asking which funds or schemes you need to create these buffers, the question I'd ask myself is, do you have proper asset allocation? Is your portfolio diversified enough across asset classes that don't have that higher correlation with each other? If the answer to that is yes, then you have an inbuilt buffer already built into your portfolio.
So, there are mistakes that somebody with a regular income would make. Are there the similar mistakes that somebody with an irregular income makes? Something like over-investing during peaks or panic selling in lows. I know some things cannot be planned at all, but do you think there are certain mistakes that somebody with not so regular income should not make at all?
Yeah, I think the whole game of investing is about making less mistakes, right? And I think when you have a irregular income that flows in, like I said, the natural tendency is you want to be over-aggressive, right? You're trying to make up for lost time or missed opportunities. And therefore, when you get this income, what you want to do is you probably chase the hottest performing product at that time. If you look a year ago, it was the small caps, right? And people were investing in actively managed mutual funds, in passive indexes. People were investing in direct equity as well. And all of a sudden, when the market goes and corrects, you find yourself in not a very comfortable position. And maybe if there is a liquidity crunch, you'll end up selling your assets at the worst possible time. There's always going to be a hot product. Today, if somebody got an influx of money, there would be a tendency to deploy it in gold and silver. So I think the key is, again, having that asset allocation and having a plan in place. Because, if you don't have a plan in place, what you will land up with is, instead of 6, 7 schemes, which are well consolidated, researched, etc., you're going to land up with 20, 30, 40 schemes, all of various shapes and sizes, all with potentially poor entry points. And that would result in a little bit of a suboptimal investing experience.
That's absolutely right. Kushal, actually, I was just thinking that no matter what, regular or irregular income, you always want better returns as an investor. You always want to get the best out of it. And there's always going to be one of these sectors, one of the, flexi cap funds or some sort of funds that are going to be doing better at that period of time. But when you're looking at passive income or different forms of passive income investments, what should they be looking at? Should it just be plain simple ETFs, something more on the bond side? How should that also be planned if they want to diversify themselves?
I think, again, in the interest of keeping it simple, we can use a simple bucketing strategy. Have 2 buckets, one for your debt, one for your equity. If you are looking at debt, you can look at fixed income plans. You can look at some good quality debt mutual funds. Even a few hybrid products, right? Maybe you can do SWPs from them as well. And then have a separate bucket, which is your equity and maybe some commodities, maybe even a little bit of REITs right now to build a good, stable overall portfolio. And I think just having these 2 and sticking to asset allocation should solve the problem for most.
Okay, all right, take that point. A good chat, Kushal. Always a pleasure speaking with you. Thank you so much for joining in today.
Thank you.
And taking us through your thoughts on what people with not so regular income do with their investments when it comes to mutual funds. With that, we'll do one thing. We'll take a quick break. On the other side, we'll focus on investing in international funds. A lot of them have reopened for subscription. Let's understand which way to go about it. Stay tuned for that conversation.
Welcome back to Mutual Fund Corner on CNBC TV18. Now we're going to be putting the spotlight on international funds. There are 6 international funds that have reopened in the recent weeks, last couple of weeks itself. Now, putting global investing back in the spotlight for us as an Indian investor. But is it the right time to actually go overseas, or does the rupee risk still cloud this opportunity? What should you be doing? How should you view these reopenings as well? What should you consider while investing? To give us all these answers, we are joined by Feroze Azeez, Joint CEO of Anand Rathi Wealth. Feroze, good afternoon. Thank you so much for joining us on the show, as always. 6 international funds, all of them have reopened just in the last couple of weeks. Everyone wants to know, rupee, we've seen it hit those record lows, even today around that 92 rupees a dollar. What should we be doing right now? Is it time to global? Is it time to increase our exposure? Is it time to start investing here?
Good afternoon, Vinnii. Like you rightly said, rupee is at 92, one of the lowest it could have been over the last several years, or it's been the highest ever in terms of dollar having been strengthened. When you look at these $7 billion limit, which has been there, and that's opened up because of rupee depreciation largely, not because of redemptions. So that's why in rupee terms, the value has actually had some headroom. So 6 funds have opened it. In my judgment, you can only use this in a staggered fashion. You should ideally only use this in a staggered fashion because rupee has a certain behavior. If you look at pattern of how a currency behaves, if you plot 25 years, today artificial intelligence is there for you to validate anything which I say, or a viewer to validate anything which I say. Look at all the last 25, 30 years of rupee vis-a-vis dollar kind of prices, and you will see one clear trend that 3-4 years, rupee doesn't depreciate, and then you have 1 year where it depreciates, making up for all the 3-4 years of depreciation. Now, for example, if you look at 1st of April 2023, rupee was at 82.83, right? And it didn't depreciate for the subsequent 2 years. And in the last 4-5 months, it depreciated by 8 rupees. So what am I trying to get to? Don't be in a hurry to buy an international fund. Because an international fund does what? Once you put in money, it buys dollars and then spends 92 rupees to buy $1 and then invests in an already inflated market, which has been the US market. Because 28 out of 70 international funds are US based. So I would not jump in just because the limit have opened. I would not buy dollars giving away 92 rupees because that's not a price which I would be very tempted to. Where rupee depreciation averages at 3% in a year where rupee has depreciated by 8%, or at least the financial year where rupee has depreciated by 8%, am I so tempted to buy an asset which has appreciated? S&Ps have appreciated, Nasdaq has appreciated. We are the globally one of the worst performing markets for this financial year. Your heart will say don't buy India, but the mind should ideally say buy India.
Take that point, Feroze. So, then as an investor who hasn't been able to invest in international funds earlier because of limits, and now those limits have reopened and they are tempted to buy some of these international funds, do you think they should still wait for some months before they go all out for international funds? How can one decide, okay, this is the time I should go about buying an international fund or putting my money here? That's the biggest talking point, because if not a dollar strengthening, then when?
So, Sonal, I was overhearing the conversation, the previous segment. Most of us are salaried employees, so you generally do an SIP. Do you have to wait to start an SIP? The answer is no. Because 10% gold and silver as a hedge, I was hearing Kushal say, needs some more impetus, because 10 can never hedge a 60. 10 can hedge a 10 even if there's a negative correlation of -1. That's when 10 can hedge 10. Not 10 can't hedge 60. So if you want to increase your hedge portion, then definitely international funds have a merit in one's portfolio if you understand what you're buying. Point one. Point two, can you do an SIP? Most of these funds have opened up for an SIP of 2 lakhs per month per PAN. So can you utilize that limit for a family member or a two? I think you should certainly do that. And 20 crore, 25 crore of us are salaried employees. So use the SIP route, and you don't have to look at all dollar prices and rupee prices for an SIP, because it's going to get staggered anyway. All what I said previously is irrelevant for an SIP investor.
Right, Feroze, point taken there. But to access global markets, now you have different options also, right? Gift City, that's there as well. You have other methods to go about it. So as an investor, should one be looking at maybe Gift City, LRS? Should one go by these mutual funds which have reopened? What is the best way or an easier way to avoid too much, or returns-wise as well?
I think simple is always very powerful in terms of making money. So I would say definitely an international fund, which is a feeder fund or even an independent fund, is a very good idea. LRS is too complex. Gift City, of course, you have to use the LRS limits to go to Gift City. If you use the LRS limits to go to Singapore or Dubai, you have to open a separate bank account, remit the money there. And of course, access has become so much easier in today's digital world. But does access mean efficiency? Absolutely not. I have seen several HNIs getting very excited that ये wealth manager मुझे सब कुछ का access दे देता है. Access से पैसे बन रहे होते तो क्या चाहिए था? Research से पैसे बनते हैं, decisive decision से पैसे बनते हैं, access से नहीं बनते. Like a pharmacy has, you can get a Cipla medicine, you can get a Ranbaxy medicine, you can get Sun Pharma medicine. That's access. Doesn't mean you will have all the 3 tablets of the same generic drug. So access doesn't produce efficiency. Simplicity has certainly done that. So to answer your question, I would definitely take the simplest route, and undoubtedly that's the feeder fund or a internationally investing Indian fund.
Okay, so you have simply stated that and explained it to us as well. So thank you for that access of your views. But Feroze, always a pleasure speaking with you. Thank you so much for joining in today. So you're not so gung-ho on international funds yet, at least at these levels when it comes to rupee. And those limits have opened up only because of rupee depreciation. It's not because people are redeeming more money. That's the crux of this conversation. Thank you so much for your thoughts today, Feroze.
Pleasure.
Okay, on that note, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.